Welcome back to the deep dive. If you are anywhere near the energy sector right now, especially upstream oil and gas, well, you know the pressure. It's intense.
Absolutely relentless. But it's also very specific pressure, isn't it?
It really is. We've pulled together a stack of sources today, and they paint a pretty stark picture for Q4 2025. You've got these huge geopolitical forces colliding head-on with the need for, well, perfect internal execution.
That's the core of it, yeah. Our mission today really is to give you the shortcut to understanding this whole environment. We want to get past the headlines and sort of connect the dots.
Connect the dots between what exactly?
Between, global market volatility, that intense regulatory pressure we're seeing, and the really specific day-to-day operational stuff. The surprising thing is how success might actually hinge on fixing, say, a back-office efficiency problem.
Right, because that frees up capital.
Precisely. Billions, potentially, for future growth.
It's this ultimate friction point. You've got global macro things happening, supply shocks, climate policy forcing these massive strategic shifts.
Billions of dollars on the line.
Exactly. But your ability to actually make those shifts, it might depend on getting one internal IT workflow or an accounting process just right.
It often does. Okay, so let's unpack this. Where should we start? Maybe the immediate market chaos. Q3 closing, Q4 kicking off.
Yeah, let's start there.
What's really fascinating, I think, is this dual challenge the upstream sector is facing. It's structural. They have to deliver reliable hydrocarbons, right? Meet that immediate demand.
The lights on, basically.
Yeah, keep the lights on. But at the same time, they're navigating this deep economic disruption, regulatory hits, all of it squeezing margins.
And there's an immediate threat on the price side coming straight from geopolitics, isn't there?
There is. We saw movement or potential movement on the Iraq-Turkey pipeline. Now, if that fully restarts, if crude flows through Turkey again.
How much are we talking?
Could be around 230,000 barrels per day back into global markets.
Okay, that's not insignificant.
No. And it directly fuels those Q4 oversupply worries. Puts immediate downward pressure on Brent, on WTI. Threatens profitability right there.
So that's the external squeeze.
That's the external. But the internal problem, the capital allocation crisis, that might be even more concerning long-term for some players.
What crisis is this?
Well, there's a recent IEA report, International Energy Agency, and it highlights that natural decline rates, they're accelerating across global oil and gas fields.
Okay, tell us what that means for the checkbook, the bottom line.
It means enormous pressure on investment.
Yeah.
Huge. If you look at the data, something like nearly 90% of annual upstream capital spending is now just offsetting those natural declines.
Wait, 90%?
90%. Think about that. That money isn't going to grow production or find new reserves or, fund a big energy transition pivot.
It's just maintenance.
It's essentially the maintenance bill. Fighting gravity, keeping current production flat. That's it.
Wow. That 90% figure is startling. Really changes the math for every CFO out there. You're not investing for growth. You're just maintaining the past.
Exactly. And that absolute need for extreme cost control, it feeds directly into the labor contraction we're seeing.
Ah, right. Workforce numbers.
Yeah, new data, U.S. Bureau of Labor Statistics, shows the oil and gas extraction workforce is shrinking. It fell to about 119,100 employees, I think, as of August 2025.
Down from
about 123,100 earlier in the year. And look, that's not accidental. It's a direct response to cost pressures.
Because if 90% of your budget is locked up in maintenance.
You have to find maximum efficiency everywhere else. Automation, consolidation, you name it. Every single department.
And we also saw a kind of strategic pivot from one of the supermajors that really underlines this profit-first thinking.
We did. BP, for example. They canceled plans for that standalone biofuels plant in Rotterdam.
Why?
They cited weak market conditions, but critically they shifted focus towards capital-efficient co-processing, but at their existing refineries.
Ah, using what they already have.
Exactly. It sends a very clear signal, I think, to the whole industry. Focus on your core oil and gas profitability. Prioritize high returns, flexibility. Put those big, capital-heavy, standalone transition projects maybe on the back burner for now.
Okay, but hang on. If companies like BP are cutting back on large-scale clean energy projects, doesn't that just ramp up the regulatory scrutiny? Especially from investors, capital markets. Seems like a conflicting signal.
It absolutely is a conflicting signal. And that's the core tension, really, for Q4.
Yeah.
One of our sources, a climate study, it definitely raises the stakes. It warns that, Planned fossil fuel expansions could derail those 1.5 degrees C targets.
Which guarantees more scrutiny.
Guarantees it,
Yeah.
particularly in OECD markets. So upstream companies, they have to anticipate this. They just must.
So agility, it's not just about hedging oil prices then, it's about navigating regulations too.
Precisely. They're being forced, really, to embed emissions mitigation tech, things like specialized methane monitoring, CCUS.
Carbon capture, utilization, and storage.
Right? They need to build that into their roadmaps now. They have to, partly to meet those evolving ESG expectations.
And keep access to capital.
And ensure they keep access to the capital they need for those massive investments we talked about, the ones just to offset decline. It's all connected.
Okay, let's recap this pressure cooker. Rising supply worries, collapsing investment efficiency, that 90% decline thing, a shrinking workforce, majors demanding core profits, all while under this intense regulatory threat. Phew. What does this mountain of pressure mean for, practical upstream strategy this quarter?
Well, a big picture strategy is non-negotiable, really. Agility. That's what defines success now. You've got to pivot faster than the market shifts.
Which translates into actions. Our sources highlighted, what, 3 key things?
Yeah, 3 non-negotiables for Q4. First, you absolutely have to aggressively hedge your exposure against that price volatility. No question.
Makes sense.
Second, position your portfolios towards what people call advantaged low break-even assets, meaning fields, often international or maybe deep offshore, that have huge scale, lower lifting costs.
Yeah.
Basically, they make money even when prices dip quite low.
Got it.
And third,
and this is critical, you have to absolutely double down, triple down maybe, on operational efficiency. Weathering that margin compression means finding the capital internally. You just have to.
And that relentless search for internal capital, for savings,
Mm-hmm.
it brings us right back to that friction point we mentioned earlier, the back office, IT.
Exactly. If operational efficiency is the absolute mandate and your workforce is shrinking, well, the industry is almost forced to look externally for that highly specialized support that can automate the complexity.
So we're shifting now from the why, the market pressure, to the how, the tactical response.
Right, because you simply can't hire enough people fast enough to manage the accelerating complexity, not with that 90% capital pressure breathing down your neck.
And this is where firms specializing in this come in. Yeah, firms like EAG Inc., for instance, they're a good example filling that vacuum left by the shrinking internal teams. They've got, over 20 years serving mining, upstream, midstream renewables.
And their core services seem like a direct answer to the pressures we just laid out. It's not just fixing a temporary glitch, is it? It seems more structural.
That's the key point. It is structural. They step in to, automate and optimize processes, which is vital because legacy systems, manual inputs, they can delay critical production decisions by weeks sometimes.
And that delay is where margins get crushed.
That's where it hits hardest. They also work on improving data reliability, transforming messy, scattered data, often stuck in old systems, into something valuable, something you can act on.
And crucially, optimizing the whole IT infrastructure. Because in upstream, midstream, that IT landscape can be really fractured. Expensive.
Oh, absolutely. And their approach reflects that need for sort of holistic solutions. You can't really fix the accounting system in isolation without looking at the IT underneath it.
So it includes things like IT outsourcing, back office outsourcing.
Yes, relying on those external, experienced subject matter experts, SMEs, to meet tough compliance deadlines. You rely on them because, frankly, your internal team is stretched thin or shrinking.
Our sources mention one specific solution, New Era Solutions. What's that about?
Yeah, New Era. It's positioned less as just a product and more as a strategy, really, designed to help clients do more with less, achieve substantial cost savings, better accuracy.
Which sounds like exactly what's needed.
When 90% of your capital is just maintaining status quo, doing more with less isn't a nice to have, it's survival. It's about cutting manual errors, boosting throughput, getting that cost reduction.
And trust matters here.
Hugely. That's why metrics are interesting. EAG apparently completes over 100 engagements a year. But
Let's make this concrete. Pull out a specific example of this kind of complex work. There was one involving a midstream company.
Yes, the example of accelerating a quorum TPS implementation for a midstream leader. Now, for listeners, quorum TPS, it's a critical financial and operational accounting system, widely used.
So getting its implementation right is key.
And absolutely key. Optimizing that is a tangible example of tackling complex, mission-critical software to get immediate financial and operational gains. It's not glamorous work, maybe, but it's essential to cash flow. Deadlines, compliance.
Okay. Now, we need to contrast this laser focus on back office efficiency, finding every penny, with the huge investments still happening elsewhere.
Yes, because companies have to be ruthlessly efficient today, precisely so they can afford those massive long-term strategic bets, those advantaged low-break-it assets we mentioned.
Like in Guyana.
Guyana is the perfect illustration. ExxonMobil just approved a colossal, what was it, $6.8 billion investment for the Hammerhead development. Stabroek Block.
That's their 7th development there.
7th, yeah. Targeting around 150,000 barrels per day, starting up, I think, 2029. Now, that $6.8 billion has to come from somewhere.
And a chunk of it comes from those internal efficiencies.
A significant portion, absolutely. Generated by optimizing operations, cutting costs, the stuff we just discussed.
It's clear this industry is changing so fast. Professionals need to keep learning, keep adapting. We saw that reflected in the conference circuit, too.
We really do. The demand for specialized knowledge is just soaring. Take the NATO A 2025 Institute in Boston.
NATO A.
National Association of Division Order Analysts. Division order analysis. That's how revenue gets split among all the working interest owners, royalty holders. It's a point of massive complexity, huge legal risk in oil and gas finance.
And the fact that it's a focus tells you something.
It tells you that even the back-end legal and financial stuff is getting more complex, not less, pushing companies toward that external expertise again.
And we also saw the NALTA conference in Miami, that's lease and title analysts, and the Inertia User Conference in Nashville, focusing on specific software features, CPE credits.
Yeah, the constant need for specialized certified education just highlights it again. The underlying systems, the compliance demands. They're too granular, change too often for anyone to get complacent. Every part of the business, accounting, land admin, it needs constant attention, specialist training.
So this deep dive has really laid bare the tension points. The upstream sector seems trapped, doesn't it? Between geopolitical supply shocks, that massive capital drain from decline rates, that 90% number still gets me, and intense regulatory pressure.
Good spot.
And all of this makes operational efficiency, whether it's through automation, outsourcing, better data, it makes it the absolute critical factor for survival, let alone success, in Q4 2025.
And connecting it back to the bigger picture, agility isn't just, corporate jargon anymore. It's a granular mathematical necessity. You need it just for resilience.
Survival and resilience.
Yeah. Success really rests on finding those internal savings, those efficiencies that free up the cash needed for the big strategic plays, like Hammerhead.
Which leaves us with a final thought for you, the listener, to chew on. Given that almost 90% of current upstream capital spending is just fighting decline, just maintaining, not growing, how much closer is the industry getting to a point where non-core specialized operational functions have to be almost entirely outsourced just to free up enough capital for essential reserve replacement and any kind of strategic growth? Something to consider as you plan your own strategy this quarter.